Good morning, everyone. My name is Michael Naidrich, and I am the COO of AmeriVet Securities, and I am pleased to be joined by our head of rates, Gregory Faranello. Greg, here we are again. Welcome.
Good to see you, Mike.
Good to see you, bud. Hope all is well with your family and you're feeling safe. All right, let's get right to it. 4 months have transpired since the Fed's extreme actions in March. Walk us briefly through the stages of the Fed and where we are today as you see it.
Sure. So, Mike, as you pointed out, back in March of 2020, when the pandemic started to rear its head here in the United States, the Fed took unprecedented actions in March with regard to the balance sheet and obviously putting a number of lending programs in place, roughly 11 in total. The balance sheet is up roughly 2.7 trillion. We break it down in 4 buckets the way we see it heading into this meeting. One is market stabilization. If you listen to a recent speech by Fed Governor Brainard, Lori Logan, who's head of the New York Fed security account, they talk about this notion of what they've done to date in terms of Treasury securities, in terms of market stabilization. February into March, extreme dislocations in terms of pricing and liquidity in both on-the-run and off-the-run Treasuries. The Fed has done a very solid job of quelling that with a combination of really taking securities out of the market and also putting in international swap lines for foreign reserve banks, and also putting a repo facility in place to take treasuries away from these reserve banks onto the Fed's balance sheet in exchange for cash. Those swap lines have since come down. They peaked at about $450 billion in balance sheet. They're back down now to about $125 billion. So market stabilization. Second part of that is money market liquidity. We saw a spike in CP rates. We saw a spike in LIBOR. Obviously, SOFR repo. Always a concern in terms of short-term money markets. The Fed put programs in place. Obviously, we saw LIBOR come down dramatically, CP come down dramatically. So both secured and unsecured rates have stabilized here. In conjunction with that, we've also seen what they call a flow of credit. So we've obviously seen a compression of credit spreads, not just the level of credit spreads with regard to financial conditions. It's also seeing that credit flow into the marketplace. The Fed has put a number of lending facilities in place, and obviously we've had the Paycheck Protection Program on the fiscal side. And then lastly, regulatory relief. You know, if you look at it, if you go onto the Fed's website, consistently since March, we've seen the Fed tweak some of the regulatory restrictions that have been in place since the last global financial crisis, temporary alleviation to help the banks from a capital perspective and ensuring that that credit flows through.
So it's been about a month and change since the last meeting. You've written 2 high-quality white papers, I think one in June and one in July. What's been discussed then in terms of the future Fed policy?
So there have been a number of things discussed in between meetings, Mike, and we've put out a couple of white papers over the last couple of months, June and July, discussing some of these dynamics. In 4 buckets, again, negative interest rates have been discussed, yield curve control and targeting, large-scale asset purchases, and in addition to that, formal guidance, forward guidance. When you look at negative interest rates, we've been vocal about that. If you look at the Fed minutes, you look at the Fed speak in between meetings, they've all but ruled that out. It's very low on the totem pole. As far as we're concerned, certainly we're hearing that from the Fed. Regarding yield curve control, where the Fed actually targets yield at certain parts of the yield curve, the rates are already very low on the short end of the curve. We've seen yield curve control from the Bank of Japan, obviously out of Australia this year. It seems like the Fed is less inclined to go that route right now. They're not as familiar with that policy as they are with large-scale asset purchases and formal forward guidance. When we speak about formal forward guidance, we speak about 2 forms. One is calendar-based, where the Fed says, look, we're going to be on hold for a certain period of time. And the other is outcome-based, right? And we saw that in the last financial crisis, where the Fed basically puts parameters around conditions as to what would make them move off of zero interest rate policy. The 2 parameters, obviously, within the Fed's mandate are employment and inflation. If you listen to the minutes, if you listen to some of the Fed speak recently, Harker and Evans, Brainard as well, they're talking a lot about inflation. The Fed has talked about missing their inflation target now for quite some time, even before the pandemic. So it seems likely, and we don't think it'll happen at this meeting, it seems likely if they do go the forward guidance route, that they will likely tie it in somehow to the Fed's symmetric 2% target.
So I know how well-read you are, and I know you're always watching this stuff very closely. Give me the what's going on in Washington right now, in reference to the fiscal side? What's playing into the Fed's mindset right now?
Sure. Now that's a great question. It's front and center. Look, the Fed has clearly pushed back to the fiscal side of the equation. Powell has been very explicit that the Fed can lend, they can't spend, right? The spending initiative has to come from the fiscal side of the equation. To date, we've had roughly, call it 3.5 phases of fiscal contribution. If you look at the top off in the PPP program, we're now working on phase 4. So the spread between the Republicans and the Democrats right now is quite wide, right? So the Republicans put a proposal on the table. It's worth roughly $1 trillion. They're looking to pare back on the unemployment benefits. At the same time, the Democrats have put the HEROES Act on the table, which is $3.5 billion. So our fundamental view right now is that tomorrow we will hear, I think, the Fed and Powell continue to push back for the need to see Washington continue to provide liquidity into the marketplace. We don't even view this as stimulus right now. We view this as pure liquidity, cash in the hands. And that's what the Republicans are looking at largely, right? It's unemployment benefits could scale down $200, which phase out over 2 months, and then leave it to the states to get to about 70% of income. They're looking at money for schools to reopen, and they're also looking at getting checks into the hands of individual constituents. In the end, right now, it seems like the two sides are far apart, but time matters here, right? We're in the middle of a pandemic. We're seeing cases rise. The Fed has done a lot. I think the Fed is prepared to do more, but there's not a question that in Washington right now, the two sides need to come together. They need to come to, at a minimal, some sort of compromise to provide some underpinning for, really, we've got 32 million people now that are still filing some form of unemployment insurance.
Yeah, it's a staggering number. So what can we expect from Chairman Powell tomorrow? And, I always appreciate how you dive into the minutes. When you get deep into it, what's the key concerns right now for the Fed?
So I think the Fed is concerned about the virus. And if you listen to the Fed speak, just say Dallas Fed President Kaplan has been very vocal about the health side being really just as important as the monetary side. And let's face it, right? We went through phase 1 of this crisis. We feel we're in phase 2. We do feel like the Fed's mindset now is moving more from a stabilization mindset of markets. We have seen markets stabilize. Volatility across rates, credit, equities have come down dramatically. So markets are functioning, which is a good thing and which the Fed wants. Now we need to look at the economy. We need to look at the employment side of the equation. Obviously, we've seen claims numbers start to kick up here as parts of the economy shut down. So I think you will hear the Fed express a concern about the coronavirus in the second half. They will express a sentiment of concern about the economy in the second half. And we expect the Fed to be steadfast. I mean, the Fed went all in March. If you listen to New York Fed President Williams recently in a speech, he was asked about exit strategies. And he said blatantly, now is not the time to focus on exit strategies. We're right in the middle of this. So we expect Powell to send a strong message. We don't really expect anything demonstrative to change tomorrow, but the Fed seems to be changing their mindset more toward accommodation, which could be fine-tuning their formal forward guidance going forward. It could include large-scale asset purchases on the longer end of the curve, but we do expect the Fed to stay the course here and continue to provide support for the economy as needed. But the primary concern, I really think, heading into the fall will be the coronavirus.
Well, Greg, I just want to thank you for your time today. It's always extremely insightful. I'm looking forward to your recap after the meeting on later today. And just thank you for your diligence. And if any of our clients would like to speak with Greg, he's always available. Please just call your client representative. I just wish everyone continued safety out there. And Greg, looking forward to doing it again. Have a great day, pal.
Thank you, Mike.